Well, welcome everyone. Thank you for coming out this morning. My name is Dayen. I'm a journalist. I write for Sloan and The Intercept and New Republic and The American Prospect, and I don't want to go on. Many others. I have a book coming out actually next year that touches on some of these banking and particularly foreclosure issues called Chain of Title. And that's coming out with the new press next May, so maybe I'll be here again. I'll introduce the panel real quickly, and just to set the ground rules, we're going to have a discussion, and then there'll be plenty of time at the end for questions. We're going to leave probably 15, 20 minutes open at the end. And then after that, there are books in the back, and I believe Mehrsa will be signing. So please avail yourself of them. So first we have Mehrsa Baradaran, who is an Associate Professor at the University of Georgia and author of How the Other Half Banks, which is out yesterday and had a very nice review in the New York Times today. It's an excellent book. There's a review of mine coming very soon in these Times Magazine. That'll be a major focus of our discussion today, is this issue of banking to low and moderate income Americans. We also have Lisa Donner, is the Executive Director of Americans for Financial Reform, one of the driving forces in the financial reform debate. Also Simon Johnson, MIT, and former chief economist in IMF, and as I know him, former blogger. That's kind of my inroad to that. And best-selling author of 13 Bankers and White House Burning as well. So I wanted to kick off the discussion by asking Mehrsa about this concept that you kick off your book about, which I think can nicely frame our discussion today, and it's about the social contract between banks and the public. And you go into this pretty deeply, going through the history of this and also how we lost it. So I wonder if you could sort of frame that for us, of how we had this public charter that was meant for some public purpose.
Thanks. Right, so I talk about it in the terms of a social contract, in that our sort of the government support of the banking industry has always been a quid pro quo, right? So we, since the days of Alexander Hamilton and Thomas Jefferson, we needed banks for a purpose, and we may have disagreed. Clearly Hamilton and Jefferson disagreed about how we wanted to structure the society, but part of it was using banks to, design the system, the framework that we wanted, and so we would, charter banks, and then later on, post-New Deal, support them, insure them, create the Federal Reserve to provide liquidity, but we also wanted something from them, right? And this was for them to, make the economy run. Banks are the engines of the economy, so they offer credit, they, make transactions easier, and so they're going to do that, and they're going to make money, but we also need them to do this for us, and so that's why we're going to, lay on all sorts of government support. And so to say, banks are subsidized by the government, I say in the book, is like saying the tires to your car are like a bonus feature. The banking system lies atop a government foundation, and without that government foundation, banks don't exist. And so the question is, why do we support banks, right? Why have this government foundation of, deposit insurance and, like I said, ex post bailouts after they get in trouble? If why we have this is that we want them to do these services. And so I think that the social contract idea was prevalent as you look at the banking history and you see some of the debates. During the founding, during the Civil War, during the Great Depression, there was a lot of debates with policymakers. Well, how do we design the banking system to best serve us? Do we break them down? Do we force them to be, small? Do we prohibit them from doing certain things for us? right? And now, in the last 30 years, I think people just stopped asking those questions. They, it's much more about bank profitability and efficiency and how do we create competitive banks for their own sake, and not what do we need out of a banking industry that we so support. And you did see the government support on full display during the 2008 bailouts, and I think there wasn't this conversation afterwards of, okay, now what? We gave them so much support and so much money through this bailout. What are we going to get for that? And I think Lisa and her organization have been really actively fighting this fight. So I'd love to hear what they want out of the banks.
Well, before we get to what want, let me maybe just sort of add on something on the question of how we got here, whoops, sorry, talking to the mic, because there are a couple of things that that question made me think about. One is that there's obviously been an assault on regulation beyond just the financial sector, and the rollback of the Depression era of the New Deal financial regulation was a part of that, even as it was even more than that for a whole variety of reasons, including that while I think the case you laid out tells a story about why the banking system is created by regulation, so it's not a question of regulation or not. It's for whom and for what and what rules and who makes them. But there's also, I think, some particular challenges to making, or there have been some particular challenges to making sure that there's a public interest perspective on how those rules gets made and who makes them. And it's been the industry is so powerful, and there's been so little kind of public interest advocacy or engagement or knowledge about these questions about the structure of the financial system, that these incredibly important decisions have been made even more like between bankers and regulators in Congress in sort of a closed circle. And so there's been pretty limited counter pressure. And then, the financial industry is the largest source of campaign contributions and the second largest source of lobbying dollars. That is no small matter in terms of shaping policy outcomes. So there's a lot of, there's just huge pressure in that direction. And maybe the last thing I'll say in a different direction is, to me, one of the most striking examples of how fundamentally lost the idea that the basic questions we should be asking about the banking system are what it's for, not just how do we prevent things from blowing up, but what do we need to do, and what do we need it to do, and that should shape the policy making and regulatory decisions. Is actually there are so many failures to make the changes that it was obvious that were needed after the crisis. But one that question made me think about in particular is around the Community Reinvestment Act, which is a rule that says, very modestly, says that banks are supposed to make loans where they collect deposits. And even immediately after the crisis, we couldn't get any updating or any improvements, and we still have not been able to get any sort of returning to replenishing the CR, which has become much less useful than it used to be for a whole variety of reasons. And in fact, the counter-narrative that CRA was responsible for the crisis, which is patently false, was so powerful that people were afraid even to talk about it in the context of financial regulation. So.
And yet you had this situation where, and that's a good one to bring up because that's exactly how it was sold. William Proxmire, when he was talking about the CRA, said, this is because they are given a public charter, we have to make sure that they serve the whole of society. And yet there was a GAO report recently that said that 97% of all CRA examinations result in satisfactory or positive. So everyone is above average, like Lake Wobegon. And yet there isn't this meaningful increase in lending to the poor. Simon, I want to bring you in just related to this social contract. Is it that there's been this substitution where the banks say, well, we are serving this public purpose, but we're doing it through innovation. Like we have all of these innovative techniques, and we don't need to be driven down by mandates or anything like that, and we can serve society through this innovation. Yet what we know is that the innovation is usually around trading and things that have little little connection to what banks, their primary purpose anyway.
So I think that is a big issue, David, the nature of innovation and who benefits from it. To tie it back to the book, I really like Mehrsa's book for three reasons, and they're quite closely related to your question. The first is that you've got to go back to the history and think about the historical origin of it, particularly in the American political tradition. And she's absolutely right. The banking is intertwined there. It is this social contract and this expectation that everyone potentially can benefit. The second point, and I think I'm as guilty as many other people, which is when we talk about financial inclusion around the world, we often talk about emerging markets or developing countries. We forget about the United States, and the nature of inclusion or exclusion or abuse in the way in which many poorer people are involved in the financial system is really, really problematic in the United States. And I think Mehrsa puts that front and center, and we need to engage with that at the policy dimension. I think what's really interesting about this moment, so I don't know if the post office will have this positive effect that Mehrsa envisages. I think it's worth discussing. But what I think this is a fantastic moment for this book and for this discussion, because technology is changing, David, as you know. You absolutely correctly characterized much of innovation in the last 30 years, creating a lot of complex derivatives, creating a lot of opaque structures, making it much harder to see where the systemic risks are and so on. We've gone through that movie. Dramatically in 2008, but we continue to see it play out today. But now we see many other potentially more decentralized technologies become available. We can, you may know this as cryptocurrency, Bitcoin. You may know it as peer-to-peer lending. You may be starting to use the term many people prefer, blockchain technology. Yeah. Now, I don't think those this is exactly Mehrsa's point. I don't think those technologies necessarily give you a more democratic, more equal access financial system. The big banks have formed a consortium to use blockchain technologies in their trading. I don't think that's what they have in mind. It's just a guess. I'm happy to be corrected on that. But there is a potential here, and there is a much more decentralized approach. Now, this is fundamentally going to change markets. This is going to put enormous pressure on intermediaries of all kinds, including banks. They're going to lose a lot of business. It changes the challenge for regulators. I don't think it means the regulators should step back, to Mehrsa's point. I think it means they should think about what their priorities are and how you establish the protocols and the guidelines and the rights and responsibilities in a decentralized network approach to finance. That's not easy. I like a lot of the work that the Consumer Financial Protection Bureau has done over the past 7 years. But they have, this will be a new set of tasks for them also, because you've got to reach into those networks and think about how are those networks functioning. But this is going to happen, and this is going to challenge the political power of the banks, because the intermediaries are going to be under pressure. It's going to create a lot of potential new opportunity, and regulation is going to struggle to keep up with it. If you don't regulate, well, we'll see what happens. But I think you need a sensible regulatory framework. Other people are doing it. The Bank of England is working on this, for example. The Bank of Canada is thinking about it. The US needs to get with this also.
Yeah, it does seem, oh, yeah, you want to make a point?
Just one second. So I think this idea that innovation, I hear this a lot too, innovation, sort of, the answer is always in tech, or, someone will create a product that will increase access, and that may be the case, but it is not necessarily the case that making things faster and quicker will increase access, right? In fact, you saw with the ATMs, right? As soon as the ATMs are created, this is a fantastic technology where, we're able to pull out money wherever, and banks you can now transfer money, you can have a bank somewhere and then pick up your money in an entirely different state. But what you saw with ATMs is it led to less community banks, right? A lot of banks shut down an office in an area and just left an ATM there. So while those people now can go to that ATM and transact, there isn't that bank. They lost a person there to lend them money, to just walk in and make transactions. And so the ATM, I think, was a fantastic innovation, but coupled with the deregulation and the mergers, it ends up a technology that decreases, to some extent, financial access.
What is the percentage, I'm trying to remember the statistic, I was trying to remember it the other day, the percentage of zip codes that have 0 or 1 bank branches is some astronomical number. It's like 50% or even more, perhaps. Yeah.
I don't know the exact percentage, it's a lot, but I do know that something like 90% of low-income areas that have a post office, and this we can talk about this later, do not have a bank. And so it's not so much a zip codes, but if you look at the low income areas, it's a drastic difference, right? There's just so few banks in those areas.
Could I add one more thing there?
Yeah, and maybe I'll prompt you, because just to stay on this topic of innovation and disrupting banks and all of these things, it seems to me that part of this is about getting outside the regulatory perimeter. That it's about figuring out a way for peer-to-peer lending to exist in a space that does not exist, where there's no real hierarchy of a regulatory apparatus to cover it, and then you get things like individuals who take a loan from SoFi, then getting 20 other cold calls because they're sharing all their data from other peer-to-peer lenders and things like that, or using direct mail techniques. And it seems like it's the future, but it's also the past. So I don't know if you were going to speak to that, but please elaborate on that.
No, I think that's exactly right, and I think, and you know, Simon said this as well. I mean, there's the danger that really the new stuff is just the old stuff, either seeking to escape regulation or, you know, doing so and then realizing that creates opportunities, you know, whether it was the goal or not, or that it actually creates, unless we, you know, build a regulatory framework that makes sense and do so quickly, or it creates additional dangers or layers them on, as you were suggesting. And I think, for example, in particular about the dangers of compounding the incredible level of the wealth gap and income gap by race, for example, that we have already, and compounding the kind of dual credit market, which has been a persistent problem and continued to impoverish the people with the least resources, not only not provide people for opportunities to grow their wealth, but actually to extract wealth from the people who can least afford it. And so if you think about, people's credit scores and lots of other information that's available about them, and that's part of the secret sauce of some of these new lenders, what's baked into those credit scores is hundreds of years of inequality and racial injustice. And so if you just compound the credit score with who's in your social network, with with where you shop, you just kind of layer on additional levels of information that it seems difficult to imagine do not end up having a disparate impact, and that it's incredibly hard to have visibility into. And so I think that needs to be taken on and quickly, or they're potentially incredibly dangerous products on the more cheerful side. Not that there isn't potential in the technology, and for example, having the CFPB as a competent and active regulator, prepaid cards, another relatively new technology, useful for people, and we actually are hopefully going to end up with a regulatory scheme that works relatively soon, relatively close to the beginning of their inception, so that the advantage of the sort of safety and control is maintained and they don't get loaded up with fees and penalties and credit products and so on and so forth. So, it's a simpler product, but.
Yes. So look, I agree with what Mehrsa and Lisa said. There's a lot of dangers here, and the closing of the bank branches, did have at that time, no doubt, significant negative effects. But the industry is changing, the technology is changing, so you just have to recognize that. I don't think we should necessarily fear all of these changes. And here's just an anecdote from a very different context. So in Kenya, as you may know, mobile money, M-Pesa, has been wildly successful. And studies done by my colleagues at MIT, Tavneet Suri, and also recent work by Teet Yokosi, show that when people in very poor areas, in slums basically, where people have very, very little by way of assets, when they get access to M-Pesa because an agent, this is the physical presence point, linking back to Mehrsa, it's not a bank opening in there near them, it's an M-Pesa agent, so you can put money in and take money, you put money in and take money out, withdraw from the system. When they open near you, that has a positive effect on lots of things, including how household income, consumption, risk sharing, and also it seems economic activity in that area. So this is with not smartphones, semi-smartphones, and semi-smartphones are a very big deal in parts of Africa. So I think looking and exploring new methods of empowerment, the M-Pesa model has not spread anywhere near as much in the developing world as you might have expected, given the success in Kenya, because regulation and, frankly, incumbent banks in other markets have kept it out.
Isn't it also that Safaricom has sort of a natural monopoly within Kenya in terms of their mobile system? So it was when they partnered with one mobile system, it was very easy and efficient to move that into that.
Yeah, so that may be an important part of the initial critical mass story in demonstrating the model works, but now we have a model out there. Lots of other companies could adopt their own version of it in either more monopolistic or more competitive settings. My point is the take-up in other low-income environments has been surprisingly low, given that it seems to really address issues for low-income people. And that's about other regulatory environments in other countries. People have put up the barriers because it's very challenging for the banks. You're cutting out banks and other incumbents from particularly financial transfers, which is the money transfers back to the village or back to other communities, which is the primary initial use of it. It doesn't deal entirely with the credit issues, and credit may be particularly dangerous and difficult, but there's many other kinds of financial services that you want at low transaction costs, and poorer people pay a lot for those services in the United States.
Right. I mean, I've been told that one of the reasons why we don't see similar innovation around the payment system in the United States is we have all this legacy issues, where in Kenya it was the difference between bartering cows or something and moving on to something that they leapt over.
The main service that this displaced was sending money back to the village. You would give cash to the driver of a minivan service, and then does the minivan make it? Does the cash make it? How do you know? And so it replaced a very cumbersome and high cost, high risk money transfer service. So that was the initial problem they saw.
And once they had those financial transactions, I mean, the GDP of the country was risen. I mean, people individually, they had these, small sort of fledgling businesses that were all of a sudden thriving just because they could use their phones to pay each other. And so the benefits are not to be underestimated here, and neither are the harms, I think, of not having that. And back to the United States, and I like how Simon says credit is particularly dangerous and interesting, and I think that's the part where people get stuck, because I think there are innovations that can deal with, check. I mean, there's no reason we need banks to clear checks anymore. These are low risk. Banks have just had a monopoly over the clearinghouses for years, but that's just because you used to have to go, the St. Louis Fed and the Chicago Fed had to meet and literally change commercial paper, and there's all sorts of rules and around it. And now I think we really don't need all of that process, but with credit, I think that's going to be difficult. But I think that's where the harms are being most felt by the poor. And this is what, going back to Lisa, I mean, she was saying the people at the bottom are bearing the weight of this high interest, and you see the Fed, last week deciding, do we keep it at 0% interest for the, 10th year in a row to the banks? Now, it's not exactly the same comparison, but banks do benefit from a lot of very easy credit from the Federal Reserve that they are then supposed to pass down to other people and increase this credit flow. And you have this whole sector of the population that has to pay a market rate for credit. And in fact, a lot of people argue that it's not market rate. It's well above market rate. I mean, 300%, that is not the cost of that loan, even though they are high risk. And so you have a substantial portion of the population, going from, I need $500 to fix my car to now I have to pay so much interest that I'm barely going to make it, so that, had you been able to give that liquidity, that $500 at a lower rate, you could bridge that gap, but because you're piling on so much interest, you're essentially sinking someone who just needed to get by. And so that's what we're dealing with people, whereas with banks, you need a short-term loan, here you go, 0% interest, pay back. So that I think is the contrast that's important, and it's not quite salient because we don't see that that's how banks work. But to go from illiquidity to insolvency for a bank is quick, right? You can be illiquid, have a run, and illiquid meaning not having enough cash to pay out, you can go from illiquidity to insolvency quickly if there's a run. But we don't let banks do that. But with people, I think it's the same thing. You can go from illiquid to insolvent also without that credit. And now what we're doing is, okay, you're illiquid, here's like an anchor, and we're gonna make you insolvent quickly.
So I want to bring Lisa back into this discussion and maybe keying off this, that it seems to me that, and something you talk about in the book, it's kind of a two-step, right? So that we create these bank deserts, we have bank branches that pull out, we limit access to credit because the poor are not very lucrative customers. And then the banks turn around and fund the high-cost lenders who can then, fetch a much higher rate of return and return that then to the banks who are their funders. So this two-step seems to be prevalent in all of the sort of halting attempts that you talk about in terms of credit, but maybe you can speak to that.
Yeah, and before I come back to credit, actually, because I do think, as Mehrsa just suggested, in a way, if you think about the postal banking idea, and I think this story about credit is the story about credit and the story about the costs of transactions are both part of what makes, and the desert is part of what makes the postal banking idea appealing and attractive. I think getting from here to there is probably a more than one-step process, and the most available step is the one that has to do with expanding some of the things that banks, the most available and simpler, has to do with expanding what post offices are doing already, which isn't credit. So on the doing already front, I'm struck, thinking about Mehrsa's book and about, I glanced at the Postal IG's most recent report, and one of the things that seems like, there are deeper things that are the big opportunity for the post office, but one specific kind of crazy opportunity is how bad the money transfer system is for just if you want to send money to your sister who suddenly is having a hard time in Poughkeepsie. It's more expensive and harder than sending money overseas. I mean, there are ways around that. There's PayPal, but that's sort of a bizarre gap in present banking services, and a gap that the post office is really well situated to fill, and that it already does some part of filling. So it seems like, not only do we have a macro need and a macro opportunity, but here's like, an odd little problem and an opportunity to solve it, which is less distant. So anyway, I just thought that.
Mehrsa, maybe you can go into the fact that, and I think that readers of your book will come to this as new information, that there's this long history, both internationally and also right here in the United States, of using postal banking services. And in fact, as you say, that's why those who are most attracted to it are recent immigrants who may have had experience within their own country. So maybe talk about the evolution of postal banking in the United States.
I'd love to, because I actually think I sort of backed into falling in love with the post office. At first I was like, this sounds like a really practical solution, and then when I got into this history, I'm like, this is just perfect. I mean, the post office is the most fascinating institution we have. I'm just going to come out and say it. Truly, I mean, it was set up before the Constitution, and I have some notes before I forget. So Ben Franklin's the first Postmaster General, and as the post office gets set up, it's very specifically an organization that is egalitarian, right? When de Tocqueville comes to the U.S. to visit, he's so impressed that the loggers in Michigan know as much about what's happening in D.C., maybe not as much, but they know a lot about it, as the same as people in New York, and that's because the post office was functional, and they made a decision early on that they would, the north-south routes that were the most profitable would subsidize the east-west routes. And so there'd be places like in, rural Michigan or, wherever the westernmost edge of the United States was at the time that was getting, that had a post office, that had literally nothing else, just a post office. And so one thing is that they would subsidize. The other is that they would subsidize the newspaper dissemination. So they would, whatever newspapers that were coming out of New York and D.C. would get out, so the mail would subsidize the newspapers just to pass the flow of information. So that's well before. But I think this is an institution that is remarkable in the role that it played in our democracy, one. Two is we had a functional and vibrant postal banking system in the United States. So it was first proposed in 1871. It took 40 years to pass. And again, I hope we don't have to repeat history there. But, you know, Great Britain started in 1861, and we proposed it, you know, 10 years later. Finally, in 1910, after the banking panic of 1907, President Taft, you know, put it through. And the thing about it is that it was almost the alternative to FDIC insurance. So those were the two options on the table. We've got these banking panics and runs. So we either have a postal banking system that is safe, where people can park their money and not have to run it because the government has backed it up, or we have FDIC insurance. And Taft thought FDIC insurance was just a complete moral hazard. As it has turned out to be, right? Banks are less, they care less about the risks of their investments if the government's just going to come and insure it, right? So he put postal banking as the alternative, and right away it was immensely popular with immigrants. So 1910, it goes from no savings to $1.2 billion by the end of the year, and it's all by recent immigrants who had postal banks in Italy or Europe, wherever they're coming from, and it lasted until 1966. And the reason why it stops being useful is that by 1966, you've got this proliferation of community banks. 1966 is the golden era of banking in America, right? We've got banks in every community because banks have a monopoly on all things money. There is no money market competition. There's interest rate caps, and so we've got a bank and a post office in every community, and the banks are paying more interest. The post office was purposefully capped at low interest because it was supposed to be the poor man's bank, so we weren't going to compete with banks. That's the only reason it got passed. So banks are in every region, so we cut down. Johnson, in his sort of streamlining the federal government, ends it. But we had this, and so it's really not, and that's why the post office still has a relic, where they do money orders. They still have that relic, but we just have no postal functions. And by the way, now all those communities that had those banks in the 60s no longer have them. And the post office remained, but without any banking function. So there's more in the book, but I think it's a fascinating history. Yeah.
Before I get to questions, and we'll do that in a few minutes, we were talking earlier about how or whether these kinds of issues are going to play in the presidential nominating race. I believe what I read yesterday is that Hillary Clinton's going to come out with some sort of Wall Street plan next week. Whether it's before or after the debate, I don't know. Whether that will be involved in the debate, I don't know. Maybe just we'll go down the row and ask, what is the most important thing to you that needs to be in there? I mean, post Dodd-Frank, what is that element? And it might not be an actual policy, but it might be around the personnel that has to implement the policies that are existing. What is most important to you when you look down in terms of a next potential Democratic president or any president, and what they need to do to modify or strengthen the regulation of the banking system? And we can start with you, Simon.
I have a long list.
I figured.
But in terms of priorities and in terms of key messages and what the president can really shape and influence, I think emphasizing the need for a lot more capital for the biggest, most complex, most opaque financial institutions, that's really critical. Some small steps have been taken in that direction. There needs to be a lot more encouragement through the Federal Reserve Board of Governors, for example, but also in terms of who's at Treasury, who's at the CFTC, other relevant regulators. And
that's a bipartisan thing. I mean, that's not something that we shouldn't just be talking about the Democratic side on that. You have Brown-Vitter and you have Thomas Honig, and there is an intellectual trend on the right to increase capital, right?
Yes, I think you chose your words carefully and precisely. And so it's not a strong political movement on the right at this stage, although there are some I think, prominent figures who should be lauded, including Senator David Vitter, Louisiana, and Tom Honig, who's a Republican nominee to the FDIC, although I believe he's a political independent. So yes, there's plenty of people across the political spectrum who get this, but it should become a much more important priority. And the point, and the way it feeds into our discussion today is that we are actually very lucky, and somewhat unusual in the United States. We have a diversified size structure in our financial system. Most other countries have lost that a long time ago. So we have these very big, complex trading houses that need to be reined in. They pose risks that are out of proportion relative to the benefits to society. And that we can do through much higher, simpler more, capital requirements, including various forms of the leverage ratio. We have a mid-sized regional bank structure that's actually doing very well, and it's taking a lot of business from the bigger players and some from the smaller players. And they need to be on a watch list. I'm not raising any flags on them yet, but they obviously, when you reach the level of $300 or $500 billion in total assets, you're getting to the Bear Stearns, Lehman type of level of activity. And then we have to pay attention to what are your interconnections, what sort of complexity, do we have resolution planning that will actually work for them. But then we come down to the community banks, and I think the key to me would be strengthen the community banks, create more opportunities for them. I'm not worried about their capital levels particularly, because I think they can and do fail, and when they fail, the insiders lose their wealth and their prestige in their communities. But then figuring out how to link that with inclusion and with these issues that Mehrsa's putting on the table is very important. And I think the best way to do it is to have sensible, smart regulators, and I think the people who run the CFPB, the Consumer Financial Protection Bureau, are doing a very good job. Now, the technology is changing. You need to stay up with it, but you need to have people who focus on this empowerment aspect of finance and are also conscious that when you promote financial inclusion, as we're trying to do here, you're also careful, as I think we are being careful, about over-borrowing, over-indebtedness, misunderstandings of debt. I mean, this is the consumer side and many people's personal experience with the subprime disaster, obviously. So it's financial inclusion, but on sensible, responsible terms. And how exactly do we structure that in a way that's inclusive? I don't think we have all the answers for that. But this is that's a great space for a political candidate to speak to, precisely because we need some more concrete ideas there.
Lisa?
So I agree with everything Simon said. And I think, I'd partially repeat, partially add. I always thought what Sheila Baird said about needing a financial system that was smaller, simpler, and safer was one very concise way to describe what we ought to be aiming for. And also, I'm fond of the Pope's line that we should have a financial system that serves rather than ruling. And sort of those two as guiding principles seem to me to be part of what needs to shape the way all of these questions are thought about. I think there's a set of concrete policies that are incredibly important next steps, including higher capital levels, including the also bipartisan, for example, Glass-Steagall, reintroduction of the separation between commercial and investment banking, which clearly goes to the simpler as well as smaller category. That Senator McCain, as well as Senator Warren and others, have supported. We think a financial transaction tax is a good part of a package to both have the financial sector be paying its fair share and to create some disincentives to high-frequency trading and excessive speculation. We think that thinking about appointments, obviously incredibly important, and taking seriously. I mean, we ask the financial regulators to do a very big and very important job, and we need good law within, to tell them what to do, but we need them to act effectively and proactively and rigorously, and so appointing people to those jobs and making it clear that the standard of who gets appointed is people with a record of and a commitment to effective financial regulation and serving the public interest. Incredibly important, otherwise the laws don't matter. Commitments to accountability so that when large financial firms break the law, there are actually consequences. Seems like an incredibly important part of the package. And obviously a commitment to, anyway, I'll stop there. I could go on.
I would like it to not be so partisan. I mean, I think that there's, you saw right after the financial crisis sort of this great populism coming out from both the right and the left. And obviously, Alexis runs another 98%, and you've seen them doing a lot of this sort of pushing for I call it populism. I know populism is usually a derogatory term, but nobody, I think, is comfortable with having another financial crisis. Nobody wants big banks that are so powerful that they're so embedded with the federal government. I mean, nobody on the right or left wants that. And I think you do see, Richard Fisher of the Texas Fed was talking about breaking up the banks, and you do see a lot of this stuff on the right and left. So I would like to see it to not being as partisan. I don't want to put all of our hopes on the Democrats to do this, because I don't really have a lot of faith in the current front runner. That I don't run for office, so I'm not going to get in trouble here, hopefully. But I think it's just not on the table. And I was saying earlier, watching the whole 5 hours of Republican debates, the one question about anything money related that was asked was, who do you want on the $10 bill? Your mom, your sister, Margaret Thatcher? You know what I mean? I mean, that was the one and only issue that came up. And so I think I get it politically why you don't want to, trash Wall Street, but it's got to be part of the debate on both sides. And to the extent that it's just the Democrats that are going to talk about it, then I'm not that hopeful, because you've got to deal with a different house, a different party in the House.
Okay, so we're going to move to questions now, and so I think there's going to be a microphone that'll be coming around, and yeah, there she is in the back. And so anyone that has any questions? Yes, over here. Go ahead. We'll wait for the mic.
My name is Steve Soiser, and I'm with the DC Public Banking Center, and I'd like the panelists just to address very briefly what would be on their wish list for services that a postal bank could provide.
I mean, first wave, I would love to see remittance, money transfers, check cashing. I'd love to see small savings accounts. And by the way, self-insured, like not with FDIC insurance, and I could talk about that. And then I would love to see small loans, capped at maybe $500, some sort of installment plan with interest, but not so much. That's what I'd like to see.
Yeah. I think one thing that gets overlooked a little bit is that if you have a postal bank, it has to abide by the Privacy Act of 1974, which means your data cannot be sold to data brokers. And that's what we're seeing in fintech a lot, is that the data is being sold all over the place to other lenders. And so I think that's a residual thing that doesn't get talked about very much when you talk about postal banking. But,
maybe I'll say one other thing on the credit side, since I didn't answer your question about it before, really, David, which is that while I think in some ways it makes sense to focus first on the things that a postal bank can do without legislative change. Important to think about what next, and a small dollar loan product I think really is an very appealing part of the what next, and not because because the alternatives out there are so bad, right? Because we have these incredibly abusive payday lending and car title and other products charging 400% interest. Again, we're making progress on regulation, which should curtail some of the worst abuses there and require that lenders meet a real ability to repay standard. But and it's very important to proceed with that as quickly as possible, and the CFPB is in the midst of a rulemaking. But having a good, and there are some good alternatives out there already that we hope will actually be able to flourish better once the bad stuff stops being pushed so aggressively. But I think there's reason to believe that a public bank like a post office bank could sell a product that would both be sustainable from a financial perspective for the institution and be sustainable for borrowers. Because if they just have to make it work, not have to have it produce maximum profit, which is what has made it impossible on a large scale to have those products available elsewhere.
So I think one of the problems we have in the U.S. is you might call it too much information around some of these financial products. You might call it signal jamming. So people put out a lot of noise that makes it hard to read the signals. If you had, someone you trusted across all communities that was really quoting prices on loans that are comparable. And I think the one that interests me the most is vehicle lending, because a vehicle is a vehicle, and you have collateral for this loan, and yet we know that the terms on which people borrow are dramatically different. The car can be repossessed, my car can be repossessed, any of your cars can be repossessed if you don't make these payments, and yet we're paying dramatically different interest rates. And we don't know that, right? A lot of it is disguised in the markups that are coming through the auto dealers, and auto dealers were also received a pretty large carve-out under Dodd-Frank. So I think you don't necessarily even need to make a lot of loans. If you have clear benchmark rates out there, that's going to change the market and change what other people can offer and change what people regard as being reasonable. So it has a much bigger catalytic effect than the volume of loans that you put through there. You need to have somebody you trust and somebody you believe in, and I'm afraid many people don't believe, with good reason, in the larger banks which have the big national presence. There are very good lenders out there, don't get me wrong, and people, I would trust individual institutions, but they don't have the national brand and they don't have the recognition. They don't reach into all communities.
Okay, next, we'll go actually over here.
Hi, David Cook, and I do consulting for banks. So I'm a little bit in the enemy camp here a little bit, but I don't think what I'm about to say is really influenced by that. I think it's more influenced by something that's a pretty common, mainstream American view, which is you look at the scandals with the VA and the IRS and the rollout of Obamacare, and there's just a real concern, I think, about whether the federal government is actually better or more efficient at managing processes that often are more efficient in the private sector. And I mean, I think we need to separate two things, because I really appreciate the aims that you're talking about. We would all love to help people break the cycle of poverty, and there's a real problem with that in our country. I wonder if the way to do that is really having an additional government bureaucracy that may or may not be efficient at delivering the kinds of things we expect it to deliver, when, if you look at the private sector, the average poor person has greater access now than they ever did to the kinds of basic money services that you're talking about. The explosion of money service businesses is extraordinary over the past couple decades. And I saw a study the other day saying that Walmart, which offers a reloadable prepaid card and other bank-like services, including ever-decreasing, money remittance services, I mean, they're ever decreasing in price, actually saves the average person 80% on bank fees. I was astounded by that. And so I just wonder, if you have a private engine that's actually providing a number of these services, if your aim is to provide cheaper credit, I think there might be more efficient ways to do that. If, on the other hand, your aim is to, augment the social net, that might be different, and that there might be different ways to accomplish it. Because I think that we've got to face the fact that there are a lot of people stuck in a cycle of poverty who are stuck there not because they don't have cheap access to credit, but because of the basic fact that they just can't make their ends meet. And no extension of additional credit is going to solve that problem. In fact, it's going to exacerbate it. And so people that, that their alternative to a money service business is to go, borrow money from their cousin Vinny or the, loan shark down the street, right? And that's a much worse situation than going to a Walmart and taking advantage of some of their money service businesses. So I guess that's my question. Sorry.
Well, yeah, no problem. Walmart's in the book, so maybe Mehrsa can talk.
Yeah, I mean, I think that's right. I think, look, let me say one thing about the federal government versus private market. And I think this is where, I mean, as you know, banks are just different than other private markets, right? I mean, I think, excuse me, I think a lot of people say, oh, well, this is a new thing where we're going to have, government-sponsored banking. And I think, as you see from, if you read, Simon's great book, and he talks about just how intertwined the banking sector is currently with the government. So I don't think it's, I think it's to say, we've got this private market, and then the post office is this new public bank. I think our banks currently are so embedded in the government that I don't think that contrast is there. But I think Walmart is offering services that are much cheaper than these payday loans. And I would actually like to see Walmart underprice the payday lending market. And to the extent it can offer a private solution that brings people in, I'm actually a fan of Walmart in that way. And I put it in the book, and I know this doesn't, it's not popular among some people, but I think I worry a little bit about pushing so much, like having this government support of banks and then outsourcing the needs of low-income people to Walmart. Because I think Walmart doesn't have a great track record of, sometimes, they come in, they underprice, then, the other good providers leave, and then they bring up the prices. So I'm not quite comfortable with saying, okay, well, Walmart will do it. I think to the extent that we have so much money already going into the banking industry, I'd like to see it go straight to the people it's supposed to be going to anyway.
We were talking earlier that Walmart has a remittance services where you can remit from the U.S. to Mexico, but that money can only be used at Walmart. So, I think that this is what she was telling me.
David, can I
yeah,
say
go
two
ahead.
things? So first of all, look, we like competition. If I think the idea here is to consider a public option. If the private sector is so much more efficient and so much better and so much more innovative, then they're going to win. They're going to win in that competition. There are, apparently underserved communities, and we certainly know that some people that the gradient or differential in pricing for a lot of credit products and other financial services is very steep across different American communities. So if that's something the private sector is going to tackle and take on in the face of this potential public option, fantastic. If it doesn't, then there is a need for this. And on the relationship between government and banks, it's fascinating at this point about who gets helped by government in what context. So what happened in 2008 and subsequently was the government provide a lot of cheap funding to the banks so they could hold on to assets and not liquidate positions that were underwater. And the assets came back, and the banks, the TARP program didn't lose a lot of money on the banking side, and the banks are very pleased with the fact that they returned to profitability. Great. How many households, if they'd been able to finance their underwater positions on their mortgages and hold on to those properties, would now be in a very different position with a great deal more wealth because the government provided them with funding and financed their position that was out of the money for a long time. I think it's millions of households. So this is to Mehrsa's point, right, which is who is getting what sort of support from the government on what basis? And is it the case, and you have to read the book and argue this out with her by email subsequently, she makes a very convincing case that we used to share the benefits of this government support much more broadly. It's become more concentrated, and she wants to tilt, it's not a revolutionary book, but she wants to tilt that balance back towards a better equality of access than we had before. I think that's it.
Hi, my name's Stephanie. I was just curious, Mehrsa and Simon both talked about the lower interest rate that would be offered by the post office and how that would be a more trustworthy sort of benchmark. So I'm just curious if it was like a high-risk customer that's coming in and getting a loan, and where this interest rate isn't necessarily going to be based on the market. I'm just interested to hear how the post office are going to arrive at that interest rate.
The interest rates are determined, payday lenders have to make their money in lending, right? So part of it is it's a higher risk person, and so you have to price for that. But there's a lot more that goes into interest rates, right? A lot of the studies of the payday lending sector show that they're not competing based on price. In other words, most payday lenders in a market charge the maximum interest rate allowable by law. So there really isn't price competition. And why not? These are loans of desperation. People come to them, they don't price shop, right? So one is I want to dispel the myth that this is the market price and there's some sort of competition and we've all arrived at 300%. That's just not the case, right? The state says 300%, we go 300%. If the state says 700%, we charge 700%, right? So the way that the post office can bring it down, one is the way Walmart's doing it. Economies of scale and scope, right? Big, and that's why we've got these huge banks that win over the small banks. The more you can do, the lower you can price it, right? So that works for the post office. Two is a lot of the payday lenders have to put in default into their calculation, right? So they have to go out and collect these loans, and those are high cost. The post office actually, because of their position in the federal government, has a lower collection cost, or they potentially could. There's a couple of treasury programs that they can take advantage of garnishing tax returns and things like that to lower the default rate, which would then lower the interest. So I think there's just some market mechanisms in place here that favor the post office. There's also less overhead, less marketing, right? You're using a post office that already exists. You're not creating a new store out of nothing. So there's some a business word like synergies or something like that, right?
Yeah. I mean, if I could add on to that a second, because I think I agreed with all of that, except perhaps I think that it makes my consumer advocate, myself and my consumer advocate friends nervous to think too much about the government's ability to garnish wages, for example, and have access to funds as a sort of super creditor as a collection mechanism. But I think there's plenty of room for the post office or some other actors to offer small dollar loans at a much more affordable rate. And there are already actors doing that and pricing in ways that allow them to cover their costs, including many credit unions and including some small community banks who offer these products. The reason those products don't get to, and they are offering them, in a sustainable way, in a way that doesn't require a loss at rates well below 36%, so enormously lower than the 300 or 400%. It's possible to do that because they're not trying to drive the payday lenders are trying to drive huge volume to their stores, and they have to maintain these storefronts that are just in the business of making payday loans. And so the cost structure would be entirely different and is entirely different for somebody who's providing these as a service. Essentially, they're not big money makers, and that's part of the reason that these alternative products aren't widespread. If you're looking to maximize your return, an affordable small dollar loan product is not necessarily your best bet. But that's exactly why something like the post office is a good place to do something like that, because they can do something that is sustainable but not a giant moneymaker.
So I like the question of vehicle lending because you're lending against collateral, and we know that the dispersion in rates and terms for this credit vary widely across different income levels and different demographics of the United States. We also know that many people don't understand fully the terms of the credit arrangements they're entering into. So again, back to David's point, my suggestion of this is that you have a public option out there that's simple, transparent. Maybe it's not the fanciest, maybe you can imagine some other kind of packaging around it, and perhaps the private sector responds by competing on the basis of their efficiencies and providing a cheaper, better product in the end. But you don't have that kind of benchmark currently in that credit market in the United States.
I think we have time for one more. We have anyone? Any further questions? Okay, one more over here. Mm-hmm.
Hi, Heidi Schooner, Catholic University. Mehrsa, you mentioned monetary policy, so you were talking about interest rates. And I wonder if you have any thoughts about how monetary policy has contributed to the banking deserts that you talk about. Community banks are disappearing in this country, and we haven't had a new community bank charter, I think maybe one in the last 5 years. And there are many reasons for that, but one of it is that the standard way that a community bank makes money, which is on the spread between loans made and interest paid on deposits, has shrunk. So I wonder if you have thoughts about, how that's contributed to this particular problem.
Absolutely, though I would love to hear Simon on this. I'm not an economist, and I try not to pretend to be one, but I think that is right. I think the reason why we had community banks that were so robust for so long isn't necessarily that that's what the market supported. I think it's we had these interest rate caps, and banks had these monopolies for so long, and heavy regulations, right? Geographic restrictions, activity restrictions that force community banks for 200 years. And so now I think they've lost that monopoly. They don't have that spread, and we've also been pushing so much easy sort of credit to the bigger banks and favored them. I think we should lament that we've lost the community banks, but I also don't know what we can do short of sort of going back to breaking up the big banks to get there. And as far as monetary policy, where do you even start with? We can't. There's an article in the Times last week or 2 weeks ago when the Fed was considering, and again, this is Simon's field, so I'll let him talk. But when the Fed was considering, increasing interest rates, they now can no longer do it through the Fed funds rate. There are so much reserves. stockpiled at the Fed that they were going to have to pay banks not to lend. Essentially, I'm oversimplifying it, but it's those tools and levers are kind of broken because there's such a glut of reserves.
Well, monetary policy obviously plays a contributing role, Heidi, in the way you're identifying. But I think the broader process behind the decline in number of community banks is the consolidation of the banking system, which is about technology. It's about some of the less than ideal developments that Mehrsa talks about in her book. And you know, I personally bank with a community bank. And the internet lets me bank with them around the country very easily. And I bank with a credit union as well. And I don't think that I think their products are very good. I think the service is excellent. I don't think that they're going away. I think what worries me much more is the subsidies that we provide to the largest banks. So the consolidation process, as you know, created some firms that are too big to fail. And you know, there's some good-natured concerns about subsidies being expressed from this table at the front. The subsidies that bother me the most are the ones that support the largest 6 financial firms, conglomerates in the United States. They get a massive advantage from their position, from the fact that the government would not substantially allow them to fail or not allow many of their creditors to suffer losses. And this impacts everything about the nature of the financial markets, the nature of our economy, and the opportunities for these smaller community banks. So that's the biggest threat that they face, is the government subsidies provided to the mega banks. So yes, the problem is government subsidies, but it's problems to the largest so-called private firms. That's the real risk to the, I regard as the strength of the American model, which is the diversity of size and the different kinds of products, different kinds of businesses that work in and around finance, subject, of course, to the caveats been expressed here today.
All right, well, I thank everyone for coming. I want to thank our panelists very much for an interesting discussion. As I said, there are books in the back, and Mehrsa will be back there signing, so I highly recommend it. It really takes you through this entire history of financial inclusion and the halting attempts that we've seen so far, and possibly the better attempts in the future. But thank you for coming, and have a good rest of your day.
Don't forget your shoes. I think that was the banking table at the front, wasn't it?
It was, yes.
Thanks. Yeah.
Thank you, David. Well done. Nice job.
Thank you.
The post office is cool.
It is cool.
And, you know, it's also the single largest union employer of unionized workers. in
Well, it's the
America.
second largest employer, period, in America, behind Walmart. It's the second largest.
And, like, the
And
pathway...
the U.S. military.
Yes, that's right. And the pathway to the middle class.
Hi, how you doing? Oh, hi, how you doing? Yeah.
It's nice to meet you. Yes.
Absolutely.
We have only had a phone relationship.
Yeah, great.
Yes.
Yeah, I got to fly out, so thank you. Thanks a lot. Anyway, yeah, well, I'm glad it brings up that she's really pushing this issue. The problem is that we have a board of governors that has 6 vacancies on it and has been under Republican control for the entirety of the Obama presidency.
Yeah, it's amazing.
Because
They don't rotate off?
they do rotate off, but they never rotate anyone on.
haven't.
They have not actually confirmed any nominees
And then they
for
nominated...
years.